reinsurance market.
Okay, we mentioned insurers earlier in the show. We were talking about Allstate, Travelers, and Chubb, all of them much higher today after hitting two-year lows last Friday. Well, fortunately, Hurricane Irene didn't take quite the toll many had expected, but it is just the start of the hurricane season, and insurers have already taken quite a beating this year. Take a look. In the first half of 2011, the U.S. property and casualty industry experienced losses of $27 billion. That's more than double the $12 billion in all of last year. So what can the insurance industry do to insure itself? Well, one way is through catastrophe bonds, or cat bonds for short. And joining me now to talk about this market is Emannuel Modu, a managing director and head of insured-linked securities at AM Best, is a firm that specializes in analyzing insurance companies. Manny, welcome to Fast Forward. Great to have you.
Thank you, Lisa.
First of all, explain how a catastrophe bond works.
Essentially, a cat bond is reinsurance between an insurance company and investors. So capital market investors basically are betting that a cat event will not happen. If a cat event happens, all their investment goes to the insurance company to cover the cat risk suffered by the insurance company. If no cat event happens, they profit handsomely because they earned a great return on their investment.
And what qualifies as a catastrophe in this case? Certainly, I would imagine a hurricane does. Does a tropical storm?
Sure. Hurricane, tropical storms, earthquakes can, hailstorms, all manner of cat losses can qualify. Each cat bond is different, clearly, so it depends on what's in the reinsurance agreements that the investors are agreeing to sign up for.
Now, what's interesting to me in looking at some of the research that you released, that it's a small market.
It is.
Why isn't it bigger?
Well, let's go back. The market actually started in 1997, and all the way through August of this year, the total cat bond issuance has been about $35 billion. Last year, the cat bond issuance was about $4 billion. It was growing at a fast pace up until 2007 when it hit a peak of $7.3 billion. Now, it's not growing as fast for a couple of reasons. One is that the cat bond market competes with the reinsurance market, actually, right, for funds. So the cat bond market is an alternative to reinsurers who are seeking reinsurance. So the reinsurance market still exists, and it's quite big, clearly. The cat bond market also requires some special knowledge. Clearly, you have to understand the kind of risks you're taking.
You're saying as a buyer,
of
catastrophe
clearly,
bonds.
right? Because the risks are you have to understand the risks that are evaluated by the special pair modelers. Essentially, the risk, you can have a default in a cat bond pretty quickly. So an event is kind of binary. Essentially, it's a high severity and low frequency event. It's unlikely to happen. The event's unlikely to happen. When they do happen, they can actually cause great damage. So it takes quite a lot to understand the dynamics of a cat bond. So,
well, big picture-wise, you would think that insurers, we were just actually from your firm putting out a lot of research on the damage that's already been done to this industry. 2011 has been a horrendous year in terms of natural disasters or catastrophes.
Right.
Why aren't they using catastrophe bonds more now?
Sure. Well, first of all, the cat season is in session right now, essentially. So you can't have more cat bonds issued now because those cat bonds will be at risk already. There'll be more cat bonds probably towards the end of the year to cover the next year's cycle. So that's why you don't see many more being issued at this point. But as I said, the industry is quite specialized. Only a number of players really understand the risks of the market. And of course, it's for qualified institutional buyers. The likes of PIMCO, Goldman Sachs, Credit Suisse, and some smaller firms like Firmat Capital and Nephila Capital are the ones who actually truly understand what's going on, their risk in cat bonds. So,
with yields so low right now, Manny, are you finding that some of these institutional investors are taking a look at catastrophe bonds? They offer, you said, I think, 700 basis points over treasuries?
That's right.
Is typical?
Most cat bonds are rated BB plus or lower. And typically, the spreads over treasury for the cat bonds is about 700 basis points over treasuries, or more, actually. If you look at the comparable corporate bond, the spread is about treasury plus 325 basis points or so. So you're looking at a 400 basis point spread. So clearly, this kind of spread will attract a lot of investors. But along with the spread, of course, is the uncertainty in the modeling of the cat bonds, and of course also the uncertainty in essentially where the cat event will hit, clearly. And also, because of the fact that you have kind of a rating cliff in cat bonds, you can have an immediate default of a cat bond. The Muteki cat bond, for example, which covered the Japan quake, basically there was a total loss of $300 million in one fell swoop back in March.
Right, so it's sort of all or nothing.
Exactly. So
to the investor.
So it takes some knowledge to really understand what you're doing.
And any particular issuer out there, we were talking, of course, Friday was a tough day for many insurers as people were speculating on potential losses related to Hurricane Irene. Right. Those companies have bounced back. I mean, I think I saw earlier today Hartford Financial was one of the best performers. Sure. Which of those insurers are active users of cat bonds or active issuers? Sure.
State Farm, of course, issued cat bond. Allstate, Chubb, all those insurers on the cat bond market in a big way. And Charters, of course, is in there as well.
And that's not necessarily reflected in their stock price.
Not necessarily. I mean, the cat bonds are really, their reinsurance sought through cat bonds is quite a small piece of their reinsurance program. So it's quite tiny. So you may not see the reflection.
All right, but potentially growing. Thank you, Emannuel,
Sure.
for joining us today. Okay. Interesting insight into a small but perhaps growing market. That was Emannuel Modu of AMS talking to us about catastrophe bonds.